Welcome back to From Corporate to Cashflow. We are Andrea Cannon and Liz Schwab, two pharmacists navigating the process of building time and financial freedom through real estate investing and lending while working our day jobs. Navigating the journey is difficult, but our podcast guests are experts in showing us how it's done. And today we have Joel Landon here with us today. Joel, thanks so much for joining us.
Happy to be here. Thank you.
Yeah, so we met Joel, both Liz and I met Joel through our own self directed retirement journey. And so today we're super, super excited to learn more about this and how it can help everyone.
Yeah, thanks so much, Joel. I think this will be a really good episode for everyone. I'm excited to share this with my family, some of my colleagues, for them to dive deeper into the self-directed retirement accounts because I know it's an area where a lot of people either just don't know the information or maybe it's super confusing, so they are struggling to get involved or open an account. And so we're really excited to dive into a few things with you here. So thank you again.
Yeah,
Um, what I want to do though is start off and see if you could just tell us a little bit about your journey, like how you became interested in finance, your current role, and then we can dive a little bit more into self-directed accounts.
yeah, for sure. Thank you again, both, for allowing me to come here and share more about this message. I think you hit it on the head, Liz. Like, this is a really valuable purpose and mission, right? To get people aware of self-directing their retirement funds. And it's just not well known. So I love that you guys are broadcasting this message to friends, families, colleagues. Um, but really, it started for me when I was working in very traditional finance and really coming up in the banking system. I thoroughly enjoyed my time working in big banking or institutional banking. I loved getting to know, the clients, the individuals, building relationships, and offering them solutions, essentially to succeed financially. Unfortunately, unbeknownst to me, I was not aware of this alternative asset space that I work in now. And I was really just immersed in the traditional finance system. And over time, I built relationships and partnerships with others in the alternative asset space. And ultimately, they invited me to come work with them. And so I started working at another bank, but it was very non traditional. So I had the opportunity to learn about this alternative asset space, specifically how individuals take retirement funds and invest them in assets like real estate, private lending, precious metals, and so forth. And when I got exposed to that, I realized that I wasn't necessarily living a lie in the institutional finance space, but I really wasn't exposed. And ultimately, my clients weren't exposed to all options and all opportunities. So it was kind of like a little vacuum or a little bubble. And once that kind of burst for me, I realized that there's just so much more. And as I started to connect with investors who've been in that space for a while, my eyes were opened. And now my message over the last 7 years, or like my mission really, is to spread this message to others, whether it's family. Like, I've spent so much time, as you can imagine, like you two have,
Mhm.
sharing what opportunity is really out there for even family members, and kind of let them take the information that I share and run with it. And of course, I get the privilege of doing this really every day with individuals across the country. And I've done this now with a couple of firms at this point. And I'll talk a little bit later about Heritage IRA, who I'm working with right now, and what our mission looks like. But that's kind of my personal journey leading up to where I am today. And just like a little bit more on the personal side, I'm a father of four daughters. I've been married to my wife, Lily, now for about 18 years. And I've spent the majority of my life in Utah. And it's been a beautiful place to obviously grow up, live, raise my family. I spent a couple of years living in the South with my family. That was a fun adventure. But we're back in Utah now, and just loving everything that the West has to offer. And super happy to be here and appreciate the time.
Yeah, Andrea and I were able to go to lunch with you, so that was very exciting. And it's great that obviously we're all in Utah together. So, very fortunate for that. So, I wanted to dive a little bit more into the self-directed IRA accounts and the differentiation between like retirement, 401ks through an employer. So, like at the very most basic level, can you help everyone understand what a self-directed retirement account is?
Yes. So I'll preface it with it's not as different as you might think than the retirement account that the listener is currently participating in. There are some nuances that make it different, and I'll go into that. But I want the listener to know right away that from like an IRS perspective or a retirement structure perspective, it's not as different than what you're already participating in. So a regular retirement account or a very traditional retirement account that you're probably participating in would be a 401k, a 403b. Maybe you have an IRA that you've been making contributions to over time. Maybe it was an IRA that you took a prior 401k and moved it into. Those retirement accounts, more likely than not, are invested through a brokerage like Fidelity, maybe Vanguard, maybe Charles Schwab. Those big companies are designed to allow individuals to invest their retirement funds in the stock market or the capital markets, things that are publicly traded. That's your NVIDIA stock, your index funds, your mutual funds. It's all really been structured and designed to help the everyday individual take retirement funds that they pull from their paycheck every pay period and invest it in the stock market for their future. So, with all of that being said, it's limited to the stock market. And the stock market, it's a beautiful place to invest. Like, there's no doubt about that. Individuals have made, their living on the stock market, and there's great opportunity. However, what I've learned, again, coming from the institutional space, the big banking world, and then transitioning into the alternative investment space, is that there are more options. There's actually more out there that the individual can invest their retirement in instead of just stocks and bonds. And typically, the individual that wants to invest in something that's different than the stock market, they want to invest in real estate. They're familiar with how real estate functions. Maybe they have their own home that they're paying a mortgage on, and they see it appreciating in value. They see the tangible asset because they're living in it, so they can kind of see where their money is going. Well, that same concept can translate into, what if I took my retirement funds and invested it in a similar type of asset? Maybe it's not the asset that I live in or the home that I live in, but maybe it's actually a duplex that I rent, and that is possible. That is actually something individuals can do. And I would say 95% of our nation, they don't know about this concept that they can actually take their retirement funds and invest in those types of assets. It is becoming more and more popular. So what we design with Heritage IRA is a retirement account similar to the traditional retirement account, but there are some provisions written in to the retirement accounts that we create that allow you to invest in alternatives like real estate. And of course, that list goes on and on. It could be precious metals, it could be venture capital. You could be doing private money lending, which is something that I do. And I know that Liz, Andrea, their community does as well. But I'll stop there and we can kind of break it down piece by piece, Liz. But that's kind of the fundamental, right? There's this
Mhm.
traditional space, and there's this other alternative space that isn't very different, but it's just you got to find the right company like ours to provide you with the tool to do it.
Mhm. So one question I get a lot is, so why can't you invest in real estate through like your employer's 401k, right? And why
Yes.
can you do that through a self-directed account?
This is actually a topic that maybe some of the listeners are actually noticing on their news feed. It's actually becoming more popular, and so much that our president, Donald Trump, he's actually trying to make it possible for big firms like, let's just say Fidelity. He is trying to actually structure retirement accounts, the same retirement accounts that we participate in as W 2 individuals, to invest in alternatives like real estate because he sees the value in it. And beyond him, individuals see the value of it. They're beating this drum of like, why can't we use our retirement funds, our traditional retirement funds, to invest? So I know that he is, and you could see this in the news, he's putting together an executive order essentially to potentially make this a possibility for the millions of Americans who are participating in a traditional 401k. With that being said, I think it was important to share that because right now, Fidelity's structure, or even just, let's just say your company's 401k, the way that it's designed
Mhm.
is designed for simplicity. The simplicity is tied to the administrator of that 401k. So let's just think of a hypothetical. You've got a company, maybe it's your local hospital, and there are, oh, let's just say, I don't know, 5,000 employees at that hospital. I don't know if that's right or wrong, but
Mhm.
5,000 employees, and they are all participating in that company 401k. Administratively, it could be a nightmare for that plan administrator to allow their participants, the 5,000 employees, to just
Mhm.
go out and find these private placements. That's what they're commonly called, but like these private investments, bring them into the plan and say, hey, administrator, I want to invest my 401k in this private placement with
Mhm.
Andrea. The
Yeah.
administrator is going to think to themselves, we've got a lot of due diligence on our hands here. We've got to go figure out how to get this asset registered now. So, for a company like that, who is not just administering the plan for that specific hospital, but maybe they administer the plans
Mhm.
for 500 hospitals in the country, that is a pain in the butt.
Mhm.
So, they limit it. It's not so much that it's not allowed, it's
Yeah.
that they don't want to do it. It's actually a huge headache for them.
Okay, that definitely makes sense because I mean, not only do I get that question, but the other question that we hear all the time is, and I mean, I'm pretty sure I asked you this one of the first times we met is, why have I never heard of this before? And in my case, I found it through, podcast reading and exploring more, just having a general interest in finance and growing wealth. But in general, I don't think the regular public is aware that these even exist, right?
Right.
So why do you think that is? I know that's kind of a hard question, but
No.
almost every single person I talk to asks that same question.
Yes, it's because if you think about it, the big the big companies out there that have essentially won over the business of the majority of 401k participants in our country, your big firms like Charles Schwab, Merrill Lynch, Fidelity, ADP, those companies have the majority of the market share and they're exclusive to the stock market. So it's no wonder. And I will even say I don't want to become political in this
Mhm.
dialogue or anything like that, but I would say too that over the last, whatever, 30, 40, 50 years, the message has always been, how can we get the trillions of dollars of retirement funds pumped into the stock market?
Mhm.
Like that's, I think, where the majority of people believe like our economy runs out or operates out of is the stock
Mhm.
market. There's no doubt about that. That the majority of companies operate out of the stock market. They offer shares of their company, etc. But there's people that don't want to feed that system. There's people that don't want to just live only in that system. They want to branch out and they want to go invest with the people in their neighborhood. It could be the individual who wants to buy up a 30-unit apartment complex in Salt Lake City. There are individuals that want to take their retirement funds and invest in that type of a cause before they go and invest in the big 10, companies within the S&P 500. So I kind of went off on a tangent there, but I think it's just more the message has always been get your money into the stock market and let it grow. It
Yeah.
is quote unquote safe. There, if you look at the stock market's return on investment over the last 50 years, guess what you see? You actually do see an upward trend, but
Mhm.
there's a lot of upward trends, inflation, for example. And so people, they like to think outside of the box. They realize that, okay, yeah, rate of return in the stock market's been on the upward trend, but there are some other upward trends that are significantly better. And, if we're going to put an upward trend up against something like inflation, it needs to do good for me to keep
Mhm.
up with some of those competing nuances.
Right. And so you had talked previously about the different items that you could invest in with a self-directed IRA. And like by term, self-directed means you get to select, but there are caveats to that, obviously, right?
Yes, so many. Like, think of it this way. So, with your 401k that you're participating in as a W 2 individual, it's already been selected for you.
Mm-hmm.
You might be able to, like, the 401k administrator might say, go in and select, from a menu that we've prepared for you. And it could be a
Right.
variety of mutual funds and whatnot. There is some autonomy, I guess, or like some agency that you could practice in that scenario, but people want more. So if you're going to take that step, you do need to understand that you are actually the administrator, if you will, or maybe the decision maker of what you want to invest in. So you
Mm-hmm.
take on the risk, right? If I'm going to self direct my retirement funds, and let's just say hypothetically, I do want to invest with you, Liz. Like,
Mm-hmm.
Andrea's got a great opportunity. I need to know the fundamentals of just general real estate investing. And what's really cool, I think, is this alternative asset space is covered with a variety of asset classes. And the people who are usually sponsoring or offering these assets, guess what else they do? They educate, they provide the insights and maybe even like the know-how so that the individual investor that's stepping into this space feels confident that they are going to make that good decision, if you will. I see it all the time. People jump into this space and initially they don't have a strong understanding of what they're getting into, but give them some time, let them work with that investment sponsor to get up to snuff. And I'm telling
Mm-hmm.
you, I know that you ladies do this as well. You educate, you try to help the individual investor understand, like, this is what you're getting into, these are the things you need to look for, this is how to properly vet an asset, etc. Now that person who is making the decision, the one who's saying, I'm going to take charge and invest my own funds the way I want, they're almost always stepping into that first investment with a really, really good understanding of what they're getting into.
Yeah, I like that. And you're right, it does come with a lot of education, which is obviously needed. And it's always good to continue the education too, right?
Yeah.
Like forever learners, because there's so many things that you may just not know or little caveats that can make a huge difference. So going back to the differences between, your regular retirement account through an employer and the self-directed. So are there any other benefits or like how does the self-directed account benefit, another healthcare professional that's busy at their W-2? Anything else outside of, the extended flexibility of being able to invest in things that you can't. It's like real estate, lending money for real estate, etc.
Yeah, totally. So I think one that popped into my mind right away was the discounted Roth conversion. And I'll break that down. This is obviously, it's like, here's that disclaimer. I'm not a tax pro. I'm exposed to this space and I've been in it so long that I know about a lot of it. But I would advise somebody who's going to listen to this right now, who might want to get into this, go hook up with your tax advisor, go find one and just start, or even just start having dialogue with somebody who is experienced in the investment space. But individuals will leverage these self-directed accounts all the time as a tax advantage tool. So the discounted Roth conversion is actually really, really popular. And what it is essentially an individual who takes, I'll use some hypotheticals here. They've rolled over from an old employer plan $100,000 in traditional funds or pre-tax funds. So you hear about traditional Roth. Traditional are your pre-tax funds that you've yet to pay taxes on. Great deduction, right? It lowers your taxable income as you're having those deductions made from your paycheck and it's getting funneled into a retirement account pre-tax. You can grow that money pre-tax. There will be a tax consequence or a tax burden, if you will, when you start to distribute at retirement, right? Because it was never taxed. So it grows, you distribute, you pay tax on the distribution. What individuals will do is they will take that $100,000 pre-tax, invest it in an asset, and depending on the asset, they may have the wherewithal or even just the knowledge that this asset is going to appreciate significantly over time. You've got these long-term holds sometimes in the private placement space. Maybe it's like an investment over 5 to 10 years, but
Mm-hmm.
they know that this asset is going to appreciate significantly over time. So what do? They convert that asset. They make the investment for $100,000. So they have on paper this really nice structured asset that says, I own this much of the tangible real estate asset, $100,000, in exchange of X amount of shares. They go to their CPA, they have that asset converted. First, they have it valued. And what happens with these discounted Roth conversions is these valuations come in lower than that initial capital investment. It happens all the time. And what I mean is, this is not facts, but in this hypothetical, but maybe the asset comes in valued at $80,000 versus the $100,000 initial capital investment. So their conversion is, or the burden is based only on $80,000 versus $100,000. So they pay that taxable burden on that discounted value. Now they watch that asset appreciate over the next 5 to 10 years. And when it comes time to either sell out or distribute, they're sitting on an asset or a return on their capital plus earnings that are significantly higher than initially. And it's Roth money, which means they're going to distribute that Roth money tax free. That includes that capital plus all of those earnings. So that was probably a really long, not tangent, but long like story. But that happens, that is taking place all the time, whether you're investing in real estate or maybe your 100,000 hypothetical is in oil and gas mineral rights. It happens all the time. So that's a really cool tool when it comes to like tax advantages and how people are using these. And I can go on and on.
That's so cool. I didn't even know that that was a thing. Both Liz and I are relatively new to the self-directed retirement account journey, and I still don't know all of the benefits. So I'm really glad we're talking now because I've never even heard of that. That's fascinating.
It is. And can I just say another thing? Um, and people probably hear this all the time, whether you're doing self-directed retirement investing or not. But if you are, go hook up with a tax professional, and, not just a tax professional that can file your quarterly business taxes or support you on an annual basis with some of your, regular tax filing. Find one that is actually willing to be creative with you and be more of a tax strategist, and put them in the hot seat. Hey, I've got this self-directed retirement tool. This is what it is. I need you as the tax professional to get up to snuff like on all of the value and benefits that come along with this. And they may have to actually do some homework, or hopefully maybe they have like a little bit of understanding of it, because there are a lot of key features that a self-directed retirement account can complement their tax strategy. And it'll make the CPA or whoever tax strategist you're working with seem like a tax god, right? Like, oh my gosh, my CPA like helps me save X amount of money each year. And then you get referrals and so on and so forth. So I always say, and I'm sure people hear this all the time, but you've really got to have invested in a good tax strategist if you want to even boost your self-directed or investment journey.
I love that. I love that. And this is so helpful because I know as we're going on our journey ourselves, we're definitely going to be diving into more of the tax advantages and things as well. So that is excellent advice for both us and everyone that's listening here.
Cool.
I know we're not going to be able to cover all of the rules that are a part of the self directed retirement account, but I'm wondering if you could highlight a couple of the do's and don'ts
Yeah.
so that they're guidelines for people going forward and they can think about those.
Totally. And I'm going to preface it with this, Andrea, if this is okay, but um, having a good custodian in your corner, I've seen over my 7 years in this industry, is like the moneymaker. It's the magic that everybody who is self-directing needs to have in their corner. And I'm talking about a bona fide trust company like Heritage IRA that is able to custody each asset and do the compliance and do the reporting. You want that in your corner. The trust company is obligated. They have a trust charter that will be stripped from them if they don't have proper compliance. We saw this recently at the end of last year with a major trust company in the country. They were actually shut down because the compliance wasn't good enough.
Wow.
So these are federally regulated organizations, and if that charter is removed from that trust company, those clients unfortunately have to be moved to another trust company that is assigned. I'm going into the weeds, and I shouldn't, but I'm trying to convey the importance of compliance. And working with a good trust company to make sure that that's happening. So speaking of compliance, a few things that you can and can't do. So right away, as far as what you can invest in with a self-directed IRA, you can invest in private placements as long as you're not investing with a disqualified individual. And that's a term that comes up actually really, really often. So the best way that I can describe it, and then I'll give you a hypothetical, is if you're investing in an asset that is controlled or managed by anybody in your direct lineage, that would be considered prohibited because someone in your direct lineage is a disqualified individual. Direct lineage is your parents, your spouse, if married, yourself, and your children. So here's a really good hypothetical. Let's just assume one of you ladies was interested in investing in a real estate project. Let's say it's like a flip. And let's say that that flip, the whole operation was being conducted by your mom or your dad or anybody else in your direct lineage. Let's say it was your spouse. That would be a prohibited transaction because that person falls in your direct lineage. And for whatever reason, the IRS has determined, and there's good reason behind it, they've determined that that's hands off. You wouldn't be able to invest in that type of operation. On the flip side, Liz, I know you guys aren't related, you're not in the direct lineage. So if Liz was operating that same project, Andrea, you wanted to become a limited partner or at least a partner in this investment, you could do that. That is allowed. That is not prohibited. So that's one of the big don'ts. I will say that this comes up every now and then. One of the big don'ts is you can't invest in collectibles. Sometimes you actually find individuals that want to invest in an asset that's actually considered a collectible. That's hands off. So I
Is
think that, oh,
Bitcoin
go ahead.
or is collectible like a car or a watch?
That's exactly right. You've got individuals out there that love to collect jewelry, just like you said, watches. Unfortunately, you wouldn't be able to, and there's a lot of value in that. I know for a fact that jewelry and watches specifically, they appreciate in value. Automobiles, Pokemon cards, like those are all real things. And there's money to be made in those industries. But unfortunately, the IRS, they're not about that. They don't want you to invest in those types of assets. So a couple of hands off. I'm going to slide a little comment into this whole compliance piece of things. I spoke about direct lineage and I spoke about prohibited individuals. And in almost every single case, you would not be able to invest in something that you operate yourself, right? I couldn't take my own funds, IRA funds, and invest it in my own, fix and flip, for example. But there's a caveat to a particular type of investment that has essentially been approved by the IRS. And it's a term known as ROBS, rollover business startup. That's kind of what it actually is referring to. And what it means is an individual is actually allowed to take funds from a retirement account, roll it over into a qualified plan, and then that plan can invest in the business startup for that individual. That is a big deal. I know individuals who have done that. I know somebody who started their own retro gym franchise in southern Utah through the Robs plan. They financed it themselves. They didn't go SBA. They actually had enough in their own retirement account that they rolled into a qualified plan to do that. There are some custodians that actually provide that plan, and we're one of them. So we actually provide the ROBS plan for individuals that want to go finance their own new company. So kind of a twist there, right? I talked about disqualified individuals. You can't invest in assets that are controlled by yourself or anybody in your direct lineage, but then suddenly there's this plan that lets you invest in your own business startup. That's the caveat. It has to be a business startup. So hopefully that gives us a little bit more to chew on. Hopefully the listener that might be, tuning into this is thinking to themselves, I want to start a business, or I'm trying to kick off a business and I don't know where to start. A Rob's plan could be a great way to cover the financing portion of that startup.
That's awesome because this is, almost serendipitous. Our last guest talked about how both her and her husband had quit their jobs and then were having trouble getting financing, even though they previously had tons of financing options because they were both very high earning W-2 professionals, including him being a physician. And so it's just interesting that you mentioned this because I haven't even ever heard of this myself. So I'm guaranteed that that will help someone just right off the bat. That's so fascinating.
Yeah. So, and I hate to dig into this, but can I spend 2 more minutes talking
Yeah.
about this? Because it's an important note. There are two things that have to really come together to even start the conversation. The first is a company like Heritage IRA that has structured the plan documents correctly. We've done that. So, and I can go into detail of this, but we have the right people in our corner at Heritage that have helped design this plan so that it complies with IRS, provisions, publications, and guidelines. The other part is the record keeping. So in the solo 401k and in the qualified plan space, specifically with these ROBS plans, it's left up to that small business owner to manage and to record keep appropriately so that they're not disqualified. And you'll notice if you go to irs.gov, there's a couple of publications that are like helpful publications that they develop to keep the individual from having their plan disqualified because there were mistakes made in the past. We have the software that we've developed. It's essentially a platform. We've compared it internally to like TurboTax, where an individual can literally just plug in the information necessary. I borrowed X amount of dollars or I invested X amount of dollars into my company's shares. And, maybe they do that over, the first 12 months of business in, multiple instances. Uh, we record that on our platform. It's reconciled. The right IRS forms are populated automatically for those transactions so that you're in compliance. That's where we're disrupting the industry at Heritage IRA so that the individual is not disqualified or their plan is not disqualified or they just don't run into any issues. I'm kind of rambling at this point, but just wanted to make that known.
No, and it sounds like you guys provide a lot of different tools to help with this process. Are there any other tools that you found that are helpful with Heritage IRA that will keep
Totally.
people on track?
Yes, totally. So a lot of individuals are small business individuals, like at the same time they are W-2 individuals. We see it often in this industry. They've got their W-2 gig, but they've also, they do their moonlighting or they do just their consulting work on the side. They want to get ahead and we are there to help them out with that. So a lot of individuals will leverage the solo 401k so that they can make contributions, right? Maybe they are partnering up with their CPA diligently, or maybe they've done the research on their own and they know, gosh, I could be making some really big contributions with my side work. It could be employee contributions, it could be profit sharing contributions, all to kind of help benefit the business, help benefit themselves as an individual, and grow their retirement. We've got tools there like calculators. Just imagine them as just general calculators that will help an individual determine just how much they can make in contributions based off of the net income that their business is generating. So in reality, if they wanted to self-manage and self-govern, they could just use that dashboard that we've designed so that they can determine, okay, I made $70,000 in net income for my business this last year. What could I make as a contribution? We'll populate all of that for them right there. And we don't get this often, but if there's a required minimum distribution, we've got that calculator as well for the individual. So some really nice tools to help formulate and calculate just how much they can contribute, what conversions and tax burdens are going to look like for them. We've got all of that on that floor as well. Some people like to take personal loans from their solo 401k. There is that provision that comes along with any 401k plan, which is you could borrow up to $50,000 if eligible from your plan for whatever you want. Like you could take that from yourself and then pay yourself back or your 401k back. Well, we have within our platform or our dashboard for the client, they could go in, they could formulate just how much they can take in a personal loan. And we'll stop them if they try to take 50,000, but they're only eligible for 40 based on cash and value. we'll stop them. Like, they won't make the mistake because our platform is designed to keep them from doing that. So they can record that plan, that loan, and we'll also formulate for them, based on their selections, what the monthly payment is going to look like for them amortized. So now they don't have to go just do the amortization calculator on their own or figure out how to do that. We've done it all for them right there on that platform. So it really is designed to cover all bases, something that's been missing in the industry for the individual who has a solo 401k or even a ROBS plan.
Wow, that's awesome. It sounds like you guys really make sure everyone's set up to do this well and correctly so that they're not making any errors, which is awesome because it can get a little bit complicated and complex. So I'm hoping you can maybe share a little bit about how you actually do the investing within the plan.
Yes, absolutely. And I'll do two scenarios just to kind of help, because there are different types of retirement accounts that I've spoken of today, right? The self-directed IRA, the ROBS, the solo 401k. So let's just kick it off with the self-directed IRA, which is used 7 out of 10 times by most individuals. Typically how it works is someone identifies a private placement. We'll stick with real estate. They understand that if they commit $100,000 to the investment, they're going to get X return, and they're happy about it and they're ready to go. They reach out to us. We create the self-directed retirement account. That usually takes us about 5 minutes because it's all automated. Then we kick off a rollover. So we actually work with the client to roll over funds from their retirement account. Maybe it's coming from that 401k that they had from a previous employer, or maybe a TSP plan because they worked in the Army or for the government for a little while. So we work with that releasing custodian to move the funds to the new IRA. That takes about 7 to 10 days. It's the longest part of the process.
Okay.
But once it's there, we've done a few things. We've got the IRA, it's funded, it's ready to invest in that private placement that they've already, chosen. So what we do at that point is we make sure the subscription agreement or the contract, whatever you want to call it, as long as there's some form of an agreement, we make sure that the IRA that we've created for them is the actual owner or subscriber or party within that contract. So as long as the IRA is the investing party on that contract, now we know we can move the funds to that investment sponsor. And we'll do that. We'll wire the funds to that investment sponsor once we know that it is compliant and that it's not, disqualified or anything like that. So at that point, the individual who wanted to do this investment had their money moved to a self-directed IRA provided by Heritage. Heritage IRA moved the funds to that investment sponsor in exchange for the equity or the shares or whatever the agreement articulated. And that's it. That is how the investment is conducted annually. If it's still an investment that's kind of brewing over the next couple of years, we do the annual form filing. And once that investment has closed, let's say the investment has reached, its term, and everybody's happy and everybody gets their initial capital plus the earnings, that all comes back to that self-directed IRA, and it could sit there and it could wait for the next opportunity, or it could even move back to an IRA with a brokerage account at Fidelity, so that individual can just invest it in the stock market if that's what they wanted to do. So probably went a lot deeper than I should have on the self-directed IRA, but that's kind of how that functions. Solo 401k is very similar. However, with the solo 401k, you kind of do it all on your own. So if you identify that investment, instead of telling us Heritage IRA, hey, I want you to move my funds to that investment sponsor, with the solo 401k, you do it yourself. You do the wire. You do the record keeping. We've got that dashboard to help you out so that you don't make any mistakes, but you do it all on your own. So you've got a couple of different types of not scenarios, but you've got two, different types of plans, but the end goal is the same. It moves from the old to the new plan, and then from the new plan to the investment.
That's awesome and really helpful to understand. So how much does this cost to set up? And is it different for solo 401k versus self-directed IRA, or can you elaborate a little bit more on the fee structure?
Yes, definitely. So for the solo 401k, which is again designed for the individual who has the self-employed activity, that is $1,500 for the setup plus $1,500 a year. so they could see that consistent expense every single year. And the main reason it's set up that way is because of that software that I was telling you about, or essentially that platform or that user experience for the person who's self-managing. We've designed that platform and we keep it up to date every single year so that the amounts that you can contribute, borrow, etc., are all the same. They're current. So that's $1,500 a year, very straightforward. The IRA is a little different, and I'll break it down like this. To run an application, it's $50. Once that's approved, we'll move over your funds from Fidelity. That movement of funds is $100. And ultimately, once that's invested with the real estate of your choice, it's $300 for that asset for the year. So an individual who finds that one investment that they want to invest in that first year, they're paying $450 to Heritage IRA to structure that investment. Let's say they want to add another one, it's $300 per asset every single year. So if they had two assets, same process, $100 to move the funds, $300 to hold the asset, but then $300 every single year. So that scenario would be $600 every single year to hold those two assets. So that's kind of how it's structured a little differently. You're paying per asset $300 with an IRA, whereas it's $1,500. You could have 50 assets registered with that solo 401k. You're managing it yourself on that dashboard. $1,500 for the solo 401k versus the IRA.
Okay, that definitely makes sense. And man, this is a lot of information. I think it's pretty clear that we could spend probably a whole day, at least at the minimum, talking about self-directed IRAs. I personally find this to be so interesting, and you're obviously a great resource too. So we'll make sure that we have your contact information so that if anyone has any additional questions or they want to get in contact with you through Heritage IRA, they can definitely do that. So thank you for providing all that information on the self-directed IRA accounts.
Yeah,
Very,
my pleasure.
very helpful. So I wanted to shift maybe just a little bit, and this can be related to self-directed retirement accounts or just like, your whole journey in general. But is there anything that you've learned throughout your, investment journey that you've come to learn that you wish you would have known earlier?
Yes. I would probably say, share, have like a partner, have a partner in the journey. It could be your friend. Maybe you're not investing directly together, but
Mhm.
you're both investing in alternatives or just even trying to learn how to invest. It could be you and your spouse. It could be you and just somebody that you know within like the investment community. I've learned my own self, and I've also learned with our clients that when you have somebody kind of side by side with you, you run faster. You get to your end goal a lot faster because it's like you have that sounding board. You have that individual that you could work with, and I'm sure you two can probably like validate that. Like you could totally agree that, yeah, when you do have somebody, you don't have to invest with them. You don't have to
Mhm.
go in and do like a big project together. That's not what I mean by any means. But when you're doing it with someone, it's so much better than trying to navigate it alone.
Completely agree. Completely
Yeah.
agree. I was literally going to use the same verbiage as you, a sounding board, right? It's nice
Yeah.
to have two sets of eyes, two different brains, different perspectives, because you could very easily be missing something or not thinking about a different scenario. And so I completely agree with that.
Yeah.
And is there anything specifically related to self-directed IRAs where you're like, ah, yes, like this makes so much sense now, right? Or I wish I would have understood this more at the very beginning and converted everything earlier.
Yeah. I would say, okay, so, I have a self-directed account myself and I've done some private lending and, don't let your emotions guide your self-directed investment. I know that I've done that before where, I saw something, I didn't put a whole lot of thought into it and I jumped on it without doing enough due diligence. And I lost out on it. It didn't play well for me. So I would say what I learned from it was take your time. I like to sleep on it overnight. If there's a great opportunity that I think looks right, it feels good, it's something I want to do, I'll take 24 hours to just sleep on it because it allows my emotions to come down. and I'm not a good emotional decision maker. And so I have to be as logical as possible, especially in this kind of industry where a lot is on the line. So I would just say, yeah, I like to sleep on it when it comes to making my ultimate decision.
That makes a lot of sense because it can be a little bit emotional with, you almost have this fear of missing out on these great returns or something. And it's nice to kind of put that away and really focus on, is my money going to be secure as the number one thing before moving
Yeah,
forward?
totally.
Yeah. So pivoting slightly, if you could give one piece of advice in 30 seconds to someone just starting their financial independence journey, what would it be?
A journal. I would say, it could be like traditional on a piece of paper, it could be on a tablet, it could be something you just speak into like a recorder, but journal because it does help you process. At least it helps me. It helps me process like my thoughts for the day, what my goals might look like. And it's really nice to reflect back, even in a week's time, and look at where you were and maybe some of the decisions that I was making and like the trajectory that I was on and course correct. So journaling has been very valuable.
That's awesome. That's a great piece of advice. And we haven't heard that from anyone yet, but you're right. It really does help you process and synthesize things a little bit better as well. So I love that. So, more of a fun question for you. Since our goal is to travel, explore the outdoors, and have fun while we're building wealth on our own journeys, we'd love to hear about your ultimate bucket list adventure or one you're looking to accomplish this year.
All right. So this may be so different than what you were hoping for or like what others have shared, but I'm actually a hunter and I do like to big game hunt. I love the backcountry, and I'm talking, and Andrea, you can validate this. I'm talking like the furthest place in the mountains, deepest that you could find, only where wild game live. We're talking bears, elk, you name it. That's where I want to be this year. And in fact, I'm going to be this year. And I'm really excited about that. It's going to be in Montana. And so my goal is to essentially go out there, spend, X amount of days in the fall and walk out or do a pack out, as they say, with your pack and your gear. And so that's like my big bucket list is spending time in Mother Nature, connecting with Earth and the wild game and whatnot.
That's awesome. Have you had any big, I don't even know if you call it hunts or how do you phrase it? What's the thing to,
Yeah.
okay.
So here's what's crazy. I've been very fortunate over the last year to what they call draw a tag or an opportunity to hunt a big game in Montana. So over the last 3 years, I've been able to do that, and I've been unsuccessful the first 2 years. But this third year, I did draw, as they say, I won a lottery to get that tag. So I'll be starting in mid-September and spending some time in the Montana backcountry to hopefully walk out with some elk. My family, we live off of that, so that's a big deal for us, and really really looking forward to a third opportunity. We're calling it the redemption season, so it's been a journey getting up to where I am this year.
I love that. I love that. And there's so much conservation that is provided through
Yes,
hunters and
yes,
the tags and the cost of them and all of that. So,
yes,
as someone who loves the outdoors, I super appreciate you and your interest in
yes.
that because it does provide so much value.
It does. I love that you said that. It really, really does. This whole program has helped sustain beautiful wild animals in our nation. So I appreciate you saying that.
Now, on the flip side, I want to be as far away from the bears as humanly possible. So, while you're doing that, and while people are learning about self-directed IRAs and retirement accounts, and as I mentioned before, I know we talked about so much information. But if someone would like to either connect with you, get to know Joel a little bit more, have a conversation with you, or maybe they're interested in creating an account and learning more about retirement accounts at Heritage IRA, what is the best way for an individual listening or watching to get in contact with you?
Yeah, I would say email me, Joel, first name, right? Joel, Joel at heritageira.com, just like it sounds. That'll be the best way to connect with me one on one. And of course, I'm on LinkedIn. There's not a lot of Joel Landons out there, so you can look for Joel Landon, and I'm really the only one in the IRA industry. with that name. So connect with me there. I'm on LinkedIn every day, trying to make new partnerships and connections. So connect with me there as well.
Awesome. Well, thanks so much, Joel, for your time today. We both, me and Liz, learned so much, and I'm sure everyone else did as well. And thanks everyone else for listening to this week's episode of From Corporate to Cashflow. We will see you next week.
Thank you.